Welcome to Accounting in the Wild, where we'll discuss various subjects in the tax and accounting world, also featuring tales from the field and interviews on various tax and accounting subjects. All this and much, much more on Accounting in the Wild. And now, here's your host, Jason Dynison.
Well, welcome to another episode of Accounting in the Wild, brought to you by MyCPE1. Visit their website at my-cpe.com to continue your professional learning journey. And that can include watching or listening to this program for continuing education credit, my-cpe.com. Make sure to include the hyphen. So today, we're going to talk about a grab bag of different topics relating to the big, beautiful bill, electronic filing of 1099s, 1099K, contractor versus employee. It's just a grab bag of different things related to things that I've been working on. I've been a practicing accountant, and now I do this full time. But when I say this, that includes teaching of continuing education courses to tax pros, CPAs, EAs, people trying to get the AFSP record of completion. I teach many of those courses at MyCPE and at a variety of other places. And so this is based on a lot of what I'm working on as an educator. And so let's start with the big, beautiful bill. I'm doing a lot of updating of course content related to that, as well as just teaching on the big, beautiful bill in general. I've started with a 2-hour session that's kind of a basic overview, and then based on feedback from people, I'm developing deeper dives into things. And one of the things that people like to ask questions about, it's certainly not the only thing, but overtime, the deduction for people who have overtime. And I think there's a few things that we can talk about on that. We did talk about it last time, but this is brand new, and so it doesn't hurt to talk about it again. So people whose income is below certain levels will be able to deduct overtime pay up to $12,500 if single or head of household, or $25,000 if married filing jointly. And actually, when we talk about things like that, I a lot of times like to say it the other way around. $25,000 for married filing jointly, $12,500 for all other filing statuses. Now, the other thing is that married filing separately cannot claim the deduction at all. The AGI limits are $300,000 for married filing jointly and $150,000 for other filing statuses. So what that means is that $25,000 or $12,500, you get the full amount of that if your AGI is below that. If your AGI is above that, then you start to lose some of the deduction until eventually it drops down to zero. A few things to say on this. One is that the IRS just last week came out with a statement, and I'm getting it pulled up here. No changes to information forms for 2025, and no changes to the withholding tables for 2025. So the law directs employers to provide information to employees to help facilitate the employee taking this deduction. So in other words, the employer will need to report qualifying overtime, which we'll talk about in just a minute. What is qualifying overtime? The employer needs to report that to the employee. Same thing with the tip deduction. Now, tips are already shown on the W-2 and generally, but maybe not always, will qualify. The same logic applies to the tip deduction, where other than just the general tip reporting that's always been the case, there's not going to be anything special on the W-2 for 2025. So the W-2 is unchanged. Also, the law directs the Treasury Department to revise the withholding tables for 2026 to account for the deduction for tips and overtime. And the IRS says that there will be no revision to the withholding tables for 2025, but they didn't say anything about 2026, other than they're working on new guidance and updated forms for 2026. One thing that I'm not sure of is how that's going to be implemented. My assumption would be that the W-4 is going to have to be updated so that the employee can tell the employer that, hey, I'm taking a deduction for overtime or tips on my tax return. So that should be reflected in my withholding. Because otherwise, how would the employer know whether or not the employee will actually take that deduction? But we'll have to see how that shakes out in 2026. The bottom line is there's no change to W-2s for 2025, but yet employers are still going to have to report applicable information to employees. And that leads into a discussion of what is qualifying overtime. So there's a few things to say on what is qualifying overtime. First of all, let's say that you get paid $20 an hour. And when you work overtime, you get $30 an hour, so time and a half. The deduction would not be on $30 an hour. The deduction would be based on the $10 extra that you get. So that's one thing that I think people have not necessarily thought about. The second thing is, what is qualifying overtime? And I'm getting it pulled up here from the text of the big, beautiful bill. Qualified overtime means overtime paid under Section 7 of the Fair Labor Standards Act of 1938. Now, what does that mean? Well, basically, that means federally required overtime because you've worked more than 40 hours in a work week. So what does that mean? Well, there are other types of overtime that are out there. So, for example, a few years ago, there started to be this concept of overtime paid to certain salaried employees. That is not overtime that would qualify for this deduction. So salaried employees who might be entitled to overtime, they're not going to be able to take a deduction. Anything that's like collectively bargained overtime would not count because that's not the Fair Labor Standards Act. That's collectively bargained overtime. Wouldn't count. Some states require overtime to be paid if someone works more than 8 hours in one day. That also would not count. It's overtime, but it doesn't count for the deduction. The big, beautiful bill specifically says Section 7 of the Fair Labor Standards Act of 1938. That means overtime when you work more than 40 hours in a work week. Now, someone asked in one of the sessions I was teaching, how will you know? Well, the answer is if your client is the individual who worked the overtime and you're preparing their 1040, you'll go with what's on the W-2, or since there's not going to be special reporting within the W-2 itself, there'll have to be some kind of separate statement included with the W-2 that shows what the qualifying overtime for the year was. And I believe you could probably go with that as the preparer of the 1040. Ultimately, this is a problem for the employer to make sure that they're tracking and reporting the proper amount of deductible overtime pay on W-2s. Another interesting discussion that has come up is relating to Trump accounts. So the Trump accounts, and that's literally what it's called in the bill, is Trump accounts. These are for kids under the age of 18. Basically, the parent can establish this investment account. And there's a lot of things we could say about that. And I've had a lot of requests from attendees in my continuing ed sessions to do a deeper dive into Trump accounts. We're not doing a deep dive here. There's one thing that I wanted to bring up, just giving a little background information on them. These are treated the same way as traditional IRAs. And so parents can put in, the law says, $5,000 a year, and it's a non-deductible contribution that gives basis in the account. And then when the child turns 18, it converts to a traditional IRA in the child's name, and they can then treat it as an IRA. Now, there's a lot of things we could say. For example, if you've ever dealt with withdrawals from traditional IRAs with non-deductible contributions in them, you know that there's algebra, there's math involved. You have to get a ratio of the basis to the account value. Now, that's something that will come down the road a long ways when the money comes out, but someone's going to have to track all of that. And if an account is established for like a 4-year-old, they're going to, and there's money put into it every year till they turn 18. That's 14 years worth of contributions that someone's going to have to track the basis on that. And when the money comes out, you're going to have to run calculations on what's taxable and what's not. But what I really wanted to talk about was the $5,000 annual limit, because that's said in one place, and then elsewhere, it is said that employers of employees who have children for whom Trump accounts have been established, employers can put in up to $2,500 as a tax-free benefit to the parent that goes into the Trump account. Now, there are varying interpretations on this. Some people say that's $2,500 a year. Some people say that it's a lifetime maximum. Some people say that the $5,000 limit only applies to what the parent can put in, and then the employer can put in another $2,500, effectively bringing the contribution limit up to $7,500 a year. Other people say, no, $5,000 is the overall limit, and if the employer puts in $2,500, then the parent can only put in $2,500 themselves. These are unknowns because the $2,500 piece for the employer, the law does not specifically say, trying to get it called up here as I'm talking, I had it on a different section. I want to get it pulled up so that we can look specifically at what the wording is on this $2,500. But basically, it's not said, it's not clear if it is yearly, or if it's a one-time thing, or if the $5,000 limit includes the employer contribution or does not include the employer contribution. So if you look, it's in section 128, and in the PDF I have, it's page 317 of the Big Beautiful Bill. And it's actually not section 128 of the Big Beautiful Bill. It would be in the Trump account part of the Big Beautiful Bill. The section 128 is a new piece to the tax code, where section 128 says that employer contributions to Trump accounts are not included in income of the employee. And it just says the limitation, the amount which may be excluded with respect to any employee shall not exceed $2,500. But it's not specified whether that's every year or not. Now, the next piece of the bill says that the 2,500 will be indexed for inflation starting in 2028. That doesn't necessarily mean, though, that it's something that can be done every year. I don't know. My initial thought is that it must be an annual thing that could be done, but it's not explicitly said in the bill. It's also not explicitly said whether the overall limit is 5,000 for all money going in, or if the 5,000 is just what the parents can put in. And then you could put in, the employer could put in more beyond that. I don't know. That's an unknown. So as this airs, just yesterday, I did a 1-hour webinar on electronic filing of 1099s. And it was the first time that I had given that session. I've taught on 1099s for over 13 years and talked about e-filing many times, but this is the first time that I've ever broken out electronic filing as its own separate standalone session. And I didn't know how it would go, but it went pretty well. And so just talking about e-filing, I wanted to talk about the way that 1099s are e-filed, because people get confused. There's a lot of terminology that gets thrown around on this. You have the FIRE system, you have the IRIS system, and then there's all these different software providers and online vendors who will e-file for you. And what does it all mean? So let's back up and take a big picture look. When it comes to electronic filing of 1099s, the IRS has two different systems, and these are just for information returns: 1099s, 1042S, anything in the 1090 series. There's two systems: FIRE, which stands for Filing Information Returns Electronically, and IRIS, which stands for Information Return Intake System. FIRE is older and dates back to the 80s. IRIS is newer and was just created in 2022. Those are the two systems that currently exist at the IRS for intake of electronically filed 1099s. So when you e-file a 1099, it is going to FIRE or IRIS. Whether you know it or not, that's exactly what's happening. It's going to FIRE or IRIS. So businesses can have their own login to FIRE or IRIS. Or if you are an accountant or a tax pro, you could have a login to FIRE or IRIS yourself. And anybody who has a login to FIRE or IRIS can go in and submit 1099 filings. IRIS allows you to type information in by hand, which is okay if you don't have a whole lot of 1099s to file. Or either system allows you to upload, as long as you have your file in the proper format, you can upload information from like CSV files or certain other files, XML files, I believe, into the system. And that works for electronic filing. Or if you don't want to do that, you can partner with a third-party provider. There's software solutions, there's online platforms that do this. They're all third-party providers. And they will e-file your 1099s. Well, here's the thing. Ultimately, those third-party providers themselves are connected to either IRIS or FIRE. And you're just interfacing with whatever system that the provider has that you interface with. Now, some of the benefits of using a third-party provider, I use one myself. There is a cost involved, whereas IRIS or FIRE, if you have your own login, it's free. But you've got to figure out how to use the system. And sometimes there's the convenience factor of having a third-party provider that'll do it for you. The other thing is those third-party providers usually will hook up to your bookkeeping system or your bill pay system, and they can actually extract information from those other systems to help you out with pulling your 1099 data together. And a lot of those platforms will do more than just e-file 1099s. They'll do things like TIN matching, TIN matching, taxpayer identification number, which is a handy service. And some of them will also offer the ability to gather W-9s electronically from contractors, which can be a big help as well. So you're kind of paying for a convenience factor when you use a third-party provider, but ultimately that provider themselves is connected to IRIS or FIRE. And so that's what we did. It was a 1-hour session on this subject, and I was happy with how it turned out. I think that it was a good session, and I look forward to giving it again. What else is on my list? 1099K was something I wanted to talk about. That's a session that I'm working on that I'll be giving in a week, is a breakout of 1099K rules. So we're not going to go into that today. Maybe later we will, in some other episode, but not today. 1099K is something that businesses will receive if they accept credit card payments, or sometimes when they receive payments through apps like PayPal or Venmo. And that's the one on the big, beautiful bill. I think we mentioned this last time. 200 transactions and $20,000 received. That's been the historic threshold for at least the payment app portion of 1099K rules. And the American Rescue Plan tried to roll that back to $600. And now the big, beautiful bill has reset the reporting back to 200 transactions and $20,000. So as soon as I give that session on 1099K, we'll do an episode here on Accounting in the Wild that talks more about 1099Ks, because that's another interesting thing to be aware of. And then one other thing that I wanted to quickly bring up is the Department of Labor and contractor versus employee. This was a few months ago, and in some places this got some coverage, but then the big, beautiful bill kind of wiped everything out on a lot of different topics. But contractor versus employee, the DOL uses what's called the economic realities test, which is something that the Department of Labor has used for many, many years. But during the Biden administration, there was some changes. There were some changes to the interpretation of the economic realities test that made it more difficult to classify workers as independent contractors. Well, now we have a new administration, which means new people in charge at the DOL who have said that basically they're not going to enforce the Biden era DOL interpretation, except in certain circumstances with certain litigation could use those older rules. But basically going forward, the DOL is going to interpret the economic realities test the way that they used to interpret it. And that's another thing where we could go deeper into it, but not today, because we're at a point where it's probably time to start wrapping this session up. But that's just something to be aware of. Those are some of the things that I'm working on right now, and just some things that I thought were interesting to talk about. And that'll do it for this episode of Accounting in the Wild. Remember, if you want continuing education credits for watching or listening to this program, head over to our sponsor, MyCPE. MyCPE1 is their name, and their website is my-cpe.com. And you can get continuing education credit for watching or listening to Accounting in the Wild. My name is Jason Dynison, saying thank you for joining us, and we'll talk to you again next time on Accounting in the Wild.
Thanks for listening, and join us next time for another edition of Accounting in the Wild with Jason Dynison.